If you are over 60 and you own your home, something is about to hit your finances that almost nobody has warned you about. And it starts this month. Not next year, not eventually. This July. And the people who will feel it first are the ones who trusted that their home, the one thing they finally paid off or nearly paid off, was supposed to be their safety net in retirement, not a new source of financial pressure. Right now, while you are going about your normal week, four separate developments are converging on senior homeowners across this country, and every single one of them carries a deadline attached to it. Not a suggestion, not a heads up, an actual clock that is already running whether you know about it or not. This is not coming from your mortgage company. It is not coming from your county tax office with a friendly phone call. It is not going to appear on the evening news with a warning label. It is going to appear as a number on a piece of mail, and by the time that envelope reaches your mailbox, several of the options you have right now to protect yourself will already be closed. So before we go further, if you know anyone over 60 who owns a home, a parent, a grandparent, a neighbor, send this to them today. Because what I am about to walk you through is breaking as of this week, and every item on this list is moving faster than most families realize. We start with the most urgent piece because the clock on this one is already ticking. This July, multiple states are activating revised property tax reassessment cycles that specifically affect homeowners who have held their properties for 10 years or longer. This is not speculation. It is written policy, passed during 2024 and 2025. Taking effect in the third quarter of 2026 in several of the country's most heavily populated retirement destinations. Here is the mechanism, and it is going to shock people when the bill lands. Under the old reassessment schedules, a home bought 15 or 20 years ago might only get reassessed every 5 or 6 years, sometimes only when it changed hands. That gap between what the county said your home was worth for tax purposes and what it was actually worth on the open market was the cushion that kept retirement budgets manageable. The new cycles compress that cushion, and in many cases, erase it completely. Assessors are now required to bring taxable values up to current market levels on a faster schedule in markets where home prices have climbed 35 to 60% over 5 years. Picture a home bought in 2008 for $180,000, now worth $420,000 on the market, but still taxed as if it were worth $210,000. Under the old system, that generates a bill around $2,520 a year at a 1.2% rate. Under the new reassessment, that same home generates a bill of roughly $5,040, a jump of $2,520 in a single year. For a household living on Social Security and modest retirement withdrawals, that is not a rounding error. That is the difference between a budget that holds together and one that collapses. Contact your county assessor's office now, before July, and ask directly whether residential properties are being reassessed this year and what your specific new value will be. Most counties must send a formal notice with an appeal window, usually 30 to 90 days. Miss that window and you are locked in for the entire cycle with no recourse. Filing an appeal typically costs under $50, and gathering comparable sales from your neighborhood, homes similar in size and condition sold in the past 6 to 12 months, can meaningfully reduce your new assessment. The second development has not made a single headline because there is no dramatic event to point a camera at. It is a slow, quiet failure that is pushing millions of senior homeowners out of protections they are legally entitled to. Every state has some version of senior property tax relief: senior exemptions, homestead protections, circuit breaker credits, senior freeze programs. The names differ, the purpose is the same: protect longtime residents on fixed incomes. The problem is that the income thresholds for these programs were set years ago and never adjusted for inflation. A senior freeze built for incomes under $35,000 back in 2009 still uses that exact number today, even though Social Security recipients have gotten a cost of living increase every single year since then. Nominal income rose, The threshold did not move. That means homeowners who legitimately need this protection are being disqualified, not because their real financial situation improved, but because an outdated number on paper says otherwise. And this is landing at the exact same moment as the new reassessment wave, meaning the households facing bigger bills are often the same households whose safety net just quietly stopped catching them. If you applied in past years and were denied for earning too much, reapply now. Several states revised these thresholds in 2024 and 2025, and nobody is calling denied applicants to tell them they might now qualify. If you have never applied at all, this is the moment. It usually only requires a recent tax return and proof of age. And in states with a senior freeze, qualifying can lock your taxable value permanently, regardless of what happens to market values afterward. The third development involves reverse mortgages, and it is causing real damage to families who thought they understood what they signed. HUD is rolling out stronger enforcement of occupancy and maintenance rules tied to home equity conversion mortgages starting this summer. And three situations are generating the most trouble. First, extended medical absence. If a borrower has been in a care facility for 12 consecutive months or longer, HUD considers the home no longer their primary residence, and the loan becomes callable, a rule that existed before but is now being tracked far more aggressively. Second, deferred maintenance. Inspections under the new protocols are flagging homes where repairs were postponed because the owner could not afford them, and issuing cure notices with tight deadlines. Third, lapses on property taxes or insurance, now verified more frequently, with far less informal grace period than servicers used to allow. If you or a family member holds a reverse mortgage, pull the loan documents today and confirm every occupancy, maintenance, and payment condition is being met. If a loved one is in a medical facility, call the servicer now to find out where the occupancy clock stands, because HUD's hardship extension process only works if you engage before the loan is formally called, not after. The fourth development is the one piece of genuinely good news, but it disappears if you do not move quickly. Multiple states are launching or expanding property tax deferral programs this July, aimed specifically at senior homeowners, allowing eligible residents to postpone paying reassessment-driven increases until the home is eventually sold. This is not an exemption. The balance still accrues with modest interest, but it can be the exact tool that lets someone stay in their home instead of being forced into a sale they never wanted. Some of these programs have income caps. Some are open to any homeowner above a certain age. Application deadlines for current year enrollment fall in July and August, and the window is open right now. One phone call to your assessor's office can tell you whether your state has one and what the deadline is. One more thing compounds all of this. Homeowners insurance premiums have spiked 30, 40, even 60% year over year in states like Florida, California, Louisiana, Texas, and Colorado. And for a reverse mortgage borrower, a lapsed policy counts as a default, the same as missing a tax payment. If your renewal notice shocked you, contact your state's Department of Insurance about Insurer of Last Resort programs before you let coverage lapse. None of this is meant to frighten you without giving you somewhere to go. Every development here has an action attached to it, and every action is still available today. The system does not send you a warning before it takes effect. It sends you a bill after. Share this with every senior homeowner in your life, because the next wave of changes will not wait either.